participant can see my screen right now. And as you see from the titles, today's topics is stock exchange and equity valuation in financial market. We will try to understand how the stocks, equities, firms like in S&P, like in Nasdaq, now Dow Jones, Russell's, or DAX in Germany, Russell in Great Britain, or let's say Bolivia in Brazil, or Turkish Stock Exchange, or Nikkei Index in Japan. So you will understand how the market will react any type of profits, price earnings, those type of issue in Tesla equity, and how the Tesla price is going up because of those fundamentals. Let's start with the first screen, which is directly about the S&P 500 index at inflection points. As you see from the chart, in the top side of the chart, we see the equity index for the S&P 500, and it's approximately started in 1996 and until today, approximately 26 years. So if you take, you can just directly think about this. If you take a position on this index during approximately 26 years at the beginning, and the index value is around 800, and it is approximately 4,800, meaning that 6 times higher. So if you put $1,000 there, it will be 6,000 today. But as you see from here, we have volatility in the index values. For instance, we put this P and E, okay, this P and E directly showing us this P and E value, price earning valuation. What we mean by price and earning? Price is the exact price of those index or equity valuation, and the earning is for the index total earning. For the equity, it is the earning, total sales, cost minus we have at the end of the profit, right? It will be my profit earning. So this price earning ratio, we will go in details. In each index value, every index put the forward value of the price earning. So it's approximately 16 at the beginning of at the end of the 1996. And in the 2008 financial crisis, price earning ratio is just around 11. Okay. And just think this, what we said a few minutes earlier, if we put this index $1,000, I mean, take a position in S&P 500, during 26 years, you will get at the end $6,000, meaning 6 times higher. But as you see, we have a volatility, and in 2008 financial crisis, the index value is less than the beginning valuation. Sorry, I will close my window as well, because lots of people outside, and maybe these voices can disturb you as well. In the 1996 and 2008 financial crisis, during approximately, we have 20 years, right? No, 10 years. We have here 10 years. And during 10 years, if you put $1,000, after 10 years, your dollar is again same. What we mean by this? Sometimes people have in their technical analysis, please keep this word in your mind. In the technical analysis, we have lots of indicators like RSI, relative strength index, like Bollinger Band, like Fibonacci. These are all mathematical and financial topics which shows sell and buy points for the index and equity. Okay, so lots of times investors take the position, and if their position get a profit value and target at the end of the period they have in their mind, they can sometimes make a take profit. Okay, take profit. What we mean by take profit? Take profit is this. I'm putting $10,000 in a position, and in 3 months, it is bringing 50%, 5,000 in just 3 months. So this is a good opportunity for me to take the profit and I can sell these stocks. So during these 10 years, if you take a profit here, meaning that you put $1,000, take your $2,000 here, and when the index dropped, then you can take again another position. Now you have $2,000, and if you take the position here again, it will reach here 12,000. But if you don't do anything, your 1,000 will be 6,000 here only. But if you take a profit here and take a position here again, now with the same time manner, with the same maturity, you will get 2 times higher. Rather than $6,000, you will get at the end $12,000. So making an investment in stock exchange or equity market or fixed income securities or financial market necessitate some consultancy from your side. If your financial literacy is low, if you don't know how to get a profit, how to take a position, where to sell and where to buy, if you don't know these issues, you can lose huge money because financial market is volatile. Fixed income securities is not, because they will get the interest return at the end of the period. There is no loss there. But as I say, if you take a position something like this, and if you take a position, look at it here, if you take a $1 million position here, in just 1 year, you will lose half of it. Okay, if you take a position here, $1 million, in just 1 year, you will lose 50%, meaning $500,000. This is a huge loss. Okay, if you don't have financial literacy, if you don't know deep knowledge of the financial market, you should get professional consultants in investment banking, asset management firms, wealth management firms, and those type of strategy, equity analysts, and macroeconomists. So as you see here, we have lots of volatilities. Here, 2008 financial crisis. Here we have COVID crisis. Here we have the Syrian crisis with Russia and United States. So S&P sometimes reached a sell point, and in those sell points, if you sell your stocks and take a position again in the good points, your profit will be learned higher, higher, and higher. And please look at this chart. This chart is exactly showing us to what we mean by PE ratio. First of all, please, all participants, take a look at this chart, what we mean by this chart and what it's shown there. If you could understand directly this chart and what it's showing here to us and what does this mean exactly, every participant can understand how I can take position in financial market and how I can change my position directly to sell off or buy side. First of all, you should understand this forward PE ratio. What I said this PE ratio about 5-10 minutes ago, PE ratio is showing the price earning ratio. Okay, so meaning that if this price earning ratio here, look at the left hand side first of all, look at the first left hand side y-axis of the chart and look at the x-axis. X-axis showing the dates, okay, years. Here 1980s, okay, 1990s, 2000, and today. Here we have, and here the multiples of the price earning ratio. What does this mean? Price earning ratio 8 times, 10 times, 16 times, and at most 28 times here. And what this value show me, what this price earning ratio shows me. In general, on basic concept, we have lots of details and exception, but from the basic concept, you should understand that price earning ratio shows me how much the equity is cheaper or expensive. Okay, I can directly understand by just looking at the price earning ratio of an equity of a firm whether to decide it is cheaper or it is expensive. So if this ratio, look at this one. What is this forward PE ratio? Look at here. It is saying that latest value is around 17.8. And the 25 years average is 16.7. And I'm here on average. And if I hear this stock, this index is expensive. Okay. If I am on the average, above the average line, I'm in the expensive side. So lots of investors all around the world today speaking about how much it is expensive about the S&P and sell-off, and how much it is cheaper and take a new position. So you should keep in mind this word, PE ratio, price earning ratio, shows me how much the index or equity. Here we have 500 index. What does this mean? We have 500 firms, stocks like Amazon, Tesla, Microsoft, Google, everything is in this index. And this PE ratio shows me how much this index higher or lower, or cheaper or expensive. If I am look at this average line, 25 years average, this green line, dash line, dot, is approximately 16.7. And if I am here, I'm cheaper. I can take a position from here because it is less than my average. Price earning is showing that this index is cheaper. And if I take the position here, and if I sell it here, I can take approximately 2 times higher valuation, get a profit. But if I am here, this meaning that the average line is approximately 16, but the PE ratio now 22. It is expensive. To take the position is in this stock exchange can be a little bit risky. Okay, so you should just keep in mind that if the PE ratio, all ceteris paribus, meaning that all other things is constant, all other things equal, my PE ratio, price earnings ratio, shows me how much my stocks is cheaper and expensive. If I am above the trend line, average line, it is expensive. And if it is lower, I'm cheaper side and I can take the position. And now, please look at here. We have a valuation analysis, and here forward PE ratio and subsequent 1-year return. So here I took for different time periods and different valuation price earning ratio metrics. And maybe, I don't know, the people here know about the statistics. Dr. Walchin, is there anybody here know about the statistics or econometrics?
I would assume so, because statistics is one of the classes or courses that are required for all programs.
Perfect.
Yeah, you.
Perfect. Perfect. Thanks for your contribution, Dr. Walchin. In statistics and in econometrics, this R square, the value here, okay, the value in the below shows how much the fitness of the good, okay, goodness of the fit for the different two things. For instance, if I'm taking petroleum prices, oil prices, and on the right hand side, if I'm taking the inflation, and if I'm putting a regression, linear regression in econometrics and statistics, how the inflation affected by the changes in oil prices. And if the R square is, let's say, 0.8, what does this mean? This means that if the oil prices increase 100%, inflation will rise 80%. Okay, this shows how these two variables correlated to each other and explain each other. Okay, this directly shows not the causality. Here there is no causality, because in economics, correlation does not mean causality. This correlation value shows us that if my R square is higher, relationship between those two variables is good, and fitness is good between those variables. So here, as you see here, the price earning for 1 year subsequent returns is just 5%. It is low. But if I look at the forward price earning with the 5 years annualized return for my index valuation, it's approximately 31%, 6 times higher from this. So 5-year annualized return is directly related, at least 30% related with my price earning ratio. And here in the third chart, what I have here in the S&P 500 valuation dispersion. What does this mean? As you remember, I have an average value for the 25 years of the stock exchange valuation of the S&P 500. This is the biggest index in the United States. And look at the title here. Valuation dispersion between the 20th and 18th percentile of the S&P 500 stocks. So I'm taking from the sample 20th and 18th percentile. So I have any confidence interval here. Remember the statistical issue between the confidence interval topics. This confidence interval directly shows me that if I take this dispersion, valuation spread means minus or summation of the average. So if I'm here average line, and if I add my average line on the above line, so the higher volatility is bigger than the lower downside risk of the S&P 500 return. This is showing my valuation metrics. As you see here, median price estimate here 16.1 and current value is 16.6. And the valuation spreads is moving around 11 to the 14. Okay, so this valuation spread showing me how my average line dispersion and how this risky to take a position in this index as well. And these are the kitchen. For instance, a few minutes ago, I said you just by looking at the price earning ratio, you can decide whether this stocks or whether this index is cheap or expensive. This is like looking a house from the outside. Okay, it can be a little bit painted, a little bit repaired, and you can suppose that everything is perfect from that house, but you didn't open the door and you didn't see the rooms and inside. Maybe everything is disaster inside the home. Okay, so by just looking the price earning ratio to take a decision on investment making process is really risky. Okay, this is like you trying to buy a car. Okay, you are just looking the car outside and don't sit, open the machine and don't take a test driving, right? You don't know how it is fast. You don't know how it is stop. You don't know how it is round. And you don't know how it is climb on the mountains, right? You are just looking at the paintings and outside condition of the car, but you don't know the motor performance of that car. So to take a position, risky position in financial market, you should enter the kitchen and you should see how those meals prepared. Okay, you should see and you should taste before you eat, and you offer those meals for your children, for your family, for your friends. You should taste it first and decide whether this is good or not, tasteful or not. So this is the kitchen. Okay, a few minutes ago, you look at the outside of the house, but you are in the kitchen now. What we mean by kitchen? Price earning is just giving us a decision making. It is cheap or expensive, but we don't know how many years this cheap index can take a profit for me. It can be cheap, but it can be cheap during the 20 years as well, right? We don't know. We don't know if you think the logic in mathematics. I'm asking this. Is this expensive or cheap? And let's say we look at the price earning ratio and we decide that this is cheap. And my second question is this. If this is cheap, should we take a position in this stock? We don't know. we need additional information because we know it is cheap, but we don't know how many years it will be cheap and how many years it will be same. Okay, so to understand when this cheap index or stocks will be expensive and its prices will be higher, we should go into the kitchen and taste the meal. Okay, and here we are in the kitchen. And the kitchen saying that from the 1980s until today, approximately 40 years, earning recession and consensus analysis estimates. Here we are, okay, on the blue and the green line. And today, the S&P 500 earning per share is saying that it will be really hard for the earning per share. Okay, price earning will be higher. It will be in expansive side. But when I look at the earning per share growth, EPS growth, not the price earning share, but the price earning earning per share growth. How can I say? The price is 10 and each year it is growing, let's say 5%. This earning per share growth showing me how much my company growing each year. It can be studied for the, let's say 20 years as well. We don't know. It can be studied during the years and the days at the same prices. We don't know. Okay, to decide whether this company will be have a good growth margins, we should look at the right hand side this chart. Okay, this chart will be our light in the earning estimates and how my company will take and will produce a growth production in their next couple of years and share of EPS growth. And today, look at this one, average for 2000 and 2022, meaning that 22 years average today, average is this one, 4.1%. But today, my margin is excellent, 9%, meaning that, look at this one. In this chart, we say that, first of all, right? At the beginning, we say directly, if I above the average line, this is an expensive stocks, right? I'm here at this point, and my average line is here. So it is above the average line. And in the first perception, I can say that this is expensive. But when I go to the kitchen, meal saying that, yes, 20 years ago, your father and mother prepared these foods with different products. But today, in the kitchen, we are preparing those meals with more delicious food and with efficient prices, meaning that during 20 years, your profit margin is around 4%, but today it is 9%. So the price is higher because we have higher and higher profit margin. Okay, so I couldn't directly say that this is expensive. If a company, just think this. Today, let's say Tesla, $3,000. One stock of Tesla today is $3,000. I'm assuming, okay, I'm not giving the exact numbers. And let's say next year, Tesla prices rises to $500, from 300 to 500, approximately 60% rise. And one can easily say that this price is really rise up and it is expensive. But if I know that during 1 year, if the Tesla increase their profit 100%, Tesla is still cheaper because price gone up just 60%, but profit gone up 100%. Okay, so while deciding whether it is cheaper or not, you should focus on the profit margin, EPS growth, and other macro indicators in financial markets as well. As I say, if the stock prices increase, let's say 20%, but if the profit margin increase 50%, I can't directly say that because of the stock prices increase 20%, it is expensive. This is a false. Okay, because my profit increasing more than the prices. I'm growing every day. I'm making investment, I'm getting profit. I'm making investment, I'm getting profit. 3 years ago, my market capitalization is $1 billion, but today my market capitalization is $10 billion. I'm higher and grow 10 times in 3 years. So my prices are still low. If you make an investment in my company, you will get profit more than you expect. Okay. So look at this chart again. This chart, as you see here, look at these margins. The margins is here and margins is here. For instance, in why here we have huge margin? Because after the COVID crisis, because the margins profits convert into loss. For instance, think this. In economics, you should know mathematics perfect. Okay, in economics, you should know mathematics perfect. When we say a base effect in calculation, base effect, this means that even if you increase in nominal numbers same amount, your return will be decreased because of the base effect. Think this, from 100 to 120, how much I increase? 20, right? And from 100 to 120, 20 over 100 is 20%. Is this correct? Yes, I increased 20%. And from 120 to 140, how much I increase? I again increase 20. But 20 over 120 is less than 20%. This is base effect. Okay, even if you increase same amount, your percentage increase will be less because of the base effect, or vice versa. So during the COVID crisis, because the margin collapsed, any small increase will create a huge effect on profit margin because of the base effects. Okay, please keep these type of things in your mind. And here in global financial crisis in 2008 and 7 as well, because the margin collapsed and recession, the next year will be a huge margin return because of the base effect. This is just base effect. For instance, you are in 100, you decrease to 50. How much you decrease? 50%, right? But from 50, if you increase to 100, you again 50, but 100%, right? So the percentage change can be changed according to your base effect. From 100 to 50, amount changes 50, percentage changes 50, but from 50 to 100, it is amount changes 50, but percentage changes 100%. This is your base effect. And after each collapse of the financial market, look at here, collapse and huge profit margin. Look at here, collapse and huge profit margin. And look at here, collapse, and here, huge profit margin. And look at here, collapse and huge profit margin. If I collapse this year, my profit margin will be really higher in the stock exchange in the next couple of years. For that reason, cash is the king. Why cash is the king? Look at it here. If you take a position here, and you don't have any money to additional position, you have all your position and your money is melt here. Okay. You want to take a position, but you don't have cash. Increase from here to here is nothing for you. But if somebody have a cash and take a position in this deep here, and if you take the position here and look at their position and valuation here, they will get a huge profit at the end of the cycle. And look at this profit margin cycle on the left hand side and the right hand side. You will understand what I mean by this type of conversion cycle as well. You will understand easily from this conversion cycle when you look at the valuation of the stocks in the stock exchange. Look at it here. When we look at on the left hand side, here S&P 500 profit margin, and look at the explanation, quarterly operating earning and sales, meaning that I have a profit earning, right? And I'm taking how many percent, how much the percent of overall sales. Okay, because I can make a turnover sales, but my profit margin can be really, really low. And look at it here. Normally, we can be here as well. Here, this gray line showing the recession and global financial crisis, COVID crisis, and those dashed lines showing the dates for those periods. And here, as you see, in the 1990s, my operating profit margin is just 4%. But today, company's profit margin is perfect. It is 12% and 3 times higher my initial 4%. So my companies in the 1990s producing less profit than today. So their prices can be higher, and this is normal because they are more profitable. Okay, if a company is profitable, their prices can be normally high, and this is normal in financial market. And look at these sectors. I mean, operating sector margins. We have lots of different sectors in S&P 500, and their operating margin can be different. And look at it here. For instance, in healthcare sector, my operating margin is just around 12%. But please look at the real estate. Real estate operating margin approximately reached 36%. It is huge. And its average is around 24%. What does this mean? If you take a position during these 25 years in the healthcare sector, or if you take a position in real estate sector, your profit will be 2 times higher in real estate sector because of real estate sector is more profitable than the healthcare or utilities or consumer discretionary or consumer staples. Okay, their profit margin is really low, just around 6 and 10%. But look at the financial market. Their profit margin, operating profit margin is around 24% as well, higher than the consumer staple or technology. Okay, and look at the value versus growth here as well. We have value versus growth and the valuation of how this recession, and look at the explanation here: growth, cheap, value, or expensive. So if I'm here, okay, value is increasing and growth cheap or value expensive, meaning that if I am here on the below of the green line, dash line, value cheap and growth expensive, meaning that I have 2 sectors. One of them is valuation, valued sector, and I have growth sectors here. And if I'm in this side, in the below side of the green line, growth sectors are expensive and value sectors are cheaper. But it is reverse on the above, on the dash line of this green dashboard, growth sectors is cheaper and value sectors is expensive. Okay, and look at it here. Impact, look at the explanation. Impact on operating income from 1% rise in revenue. What does this mean? If my operating income or if my revenue increase 1%, how much my operating income increase? Because revenue can increase, right? Revenue is my overall sales. But if my operating income rises, how much it is reflected to my overall revenue is, it is perfect in energy, normal in real estate, average in materials, and consumer staples is reverse, meaning that if operating income is increasing 1%, my revenue is decreasing. This is shocking. And if I took this type of position in energy side, if my company is in energy sector giving a huge valuation, this can be an increased return on my side. And this is small capitalized or large capitalized stocks, meaning that, like, let's say Microsoft, largely capitalized firm, or Google, large capitalized firm, or let's say Murphy Oil. It is a small capitalization, right? It's around just $4 billion. And here, as you see, percentage of index market capitalization, as you see, large capitalization is high in information technology because information technology is really popular in today's world and their market capitalization is higher. But real estate, shocking. As you see here, real estate giving the perfect profit margin on my return. But here, as you see, their market capitalization is really low. So meaning that they are small firms. Their market capitalization is really low. And on the right-hand side, interest rate coverage ratio. What does this mean? For instance, think this, in the beginning of the class, Dr. Walchin said you that, do you have money? And if you have money, I will borrow, right? So like the Dr. Walchin, every company borrow from the market, okay? They are borrowing from banks. They are borrowing from other international institutions. And if you take a, let's say $1 billion, you have a maturity and reimbursement, right? In each period, you are paying some of your debt. And in each period, those debt have interest rate expense as well, right? You have $1 billion overall debt, but in each period, you are paying your interest rate expense as well. Because each debt has an interest rate expense. And this interest rate coverage ratio showing that if your company with that profit can pay their interest rate payment, it is good. And look at it here. What does this graph showing us? Large capitalized firm, on average, has operating income 6 times higher than their interest rate expense. So they can pay their interest rate and 5 times money can be at their hand to make other investment decisions because they can directly pay those things. For instance, if you look at a company and if their interest rate coverage ratio is just 0.8, what does this mean? This means that your company does not paying their overall debt. Even they are hard to finance their interest rate payment on periodically. So you shouldn't pay any money. You shouldn't put any money in that stock because that company does not pay their overall debt. Even they couldn't achieve to pay their interest rate expense. Okay. So interest rate coverage ratio should be higher for a company to pay their overall debt, to make an investment on those stocks. And here we have global equity market return. What we mean by, until here, we try to cover the United States S&P 500, the best well-known financial market valuation. And here, as you see, we are trying to look at other financial markets like United States 500 here. Here we have Europe excluding United Kingdom. And here emerging market we have. And selected countries like from developed and developing, from developed Japan, United Kingdom, France, Canada, Germany, and from developing market, we have China, Taiwan, India, and Brazil. And here we have what is their overall equity return in 1 year. So as you see, in 2020, lots of the market all around the world lost their value, right? They lost value because of the Federal Reserve interest rate hike. The United States Central Bank increased their interest rate, and this brings a capital outflow from the stock exchange. So they lose the value. But during the 2023, lots of markets give a positive return in their valuation. And except China, because China has a problem in their real estate sector, except China, all markets give an excellent return. And look at this, approximately 26% in Japan in their local currency. This is good. And you can directly here understand that if my return is 26% in Japanese yen, and if my return in United States dollar is just 11%, meaning that this minus this, meaning that 15% Japanese yen depreciated against United States dollar. When I convert my return into United States dollar, it is less than 15% of the Japanese yen return. And here we have weights in MSCI All Country World Index. And MSCI is Morgan Stanley indexes all around the world and perfect. You should keep in mind these indexes as well. this index showing how the MSCI contribution from the all over the world, and 60% coming from the United States, 11% coming from the emerging market, 11% from Europe, UK is 4%, Japan is 5%, Pacific is just 3%, and Canada is 3%. So MSCI index also directly affected by the United States and emerging market and Europe. And revenue of the country, as you see, total revenue, percentage of total revenue from home countries, as you see, emerging market has a perfect revenue in the percentage level. And last two slides, cycles of the United States equity outperformance. As you see, how much it is outperformance during approximately until here, from the 1970s. We have here 50 years. And during this 50 years, look at this cycle here. In just 5 years, your stock increased in this period between 1980s and 1990s. In just 6 years, your stocks is increased 300%. And here in 1980s, in just 2.5 years, it is increased 80%. And here in 14 years, it is directly increased 278%. Meaning that the best well-known return in short time period in 1990s, dot-com and technology bubbles, during 6 years, approximately 300%. And here, international valuation and dividend yield we have. International valuation meaning that how my MSCI valued in the price earning ratio. Okay, as you see here, we have average and one standard deviation from my average. As you see, overall years, 20 years here, and my overall price earning ratio is negative. Okay, and my average is around minus 15% international valuation, and I'm really less than it, meaning that international valuation all around the world is really cheap if I look at the price earning ratio, because my value is really, really less than my average. And here, international difference in yield. So dividend yield means that if I buy a stock from a company, each year, this company distribute their profit to their shareholders. And I'm one of the shareholders of that company. And each year I'm getting a dividend from that company. So while taking a position in international market and financial decision-making process, you should also look at the firms that paying regular dividend yields for their shareholders. Okay, at the end of the period, because you will get your beginning investment even maybe in 2 or 3 years in some stock exchange. Okay, because of your dividend yield. And last slide, international equity earning and valuation. On the left-hand side, you see on the blue line in Japan and the purple China, the EM emerging market, green is Europe, and the black is United States. And as you see, global earning ratio here is excellent in United States and China, but it is not good in, let's say, Japan or emerging market. Okay, and on the right-hand side, global valuation, I see that if my global valuation, if I look at it, my average line, look at this, current is blue, and my average is this one. My average is this. So if my current is less than my average, it is cheap. I can take position. And look at it here. My current is here, and my average is here. So Europe Stock Exchange is cheaper. Okay, but I can't say the same for the United States, because the United States here, but its average line is here. So today, maybe the United States a little bit expensive to take the position when we compare to European financial market.